Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
Okay, let's just look at the tape right now. Applied Materials AMAT is currently trading with an average daily volume of roughly 8.11 million shares. Now, on volatile days, we're seeing that number spike, sometimes north of 11 million. So we're looking at a massive liquidity profile here, provided by a public float of approximately 790.61 million shares, and that almost entirely mirrors the total shares outstanding. I mean, this isn't a low float flyer or some kind of speculative meme stock. This is the heavyweight engine of the semiconductor industry.
And yet, look, despite that massive liquidity and just the sheer industrial scale, the market is treating it with significant skepticism. We're looking at a January 2026 research report that frames Applied Materials as navigating a structural pivot. But when I dig into the data, I don't just see a pivot, I see a divergence. You have a company entering its sixth consecutive year of revenue growth, yet it's trading at a distinct, almost painful valuation discount relative to its closest peers, specifically Lam Research and ASML.
It is exactly that discount that creates the central tension we need to debate today. The core question is this: is AMAT a misunderstood giant offering a margin of safety for the coming 2-nanometer logic node transition? I mean, is it a bargain hiding in plain sight? Or is it a value trap weighed down by geopolitical de-risking and a perceived lack of pure-play AI exposure? Now, I am firmly in the camp that this is an undervalued, diversified cornerstone of the industry. The market is unfairly penalizing it just for not being a pure AI play like some of its peers.
And I view it from the complete opposite angle. I believe the market is correctly discounting AMAT. That valuation gap isn't a mistake. It's a reflection of a harsh new reality. We are looking at a structural loss of Chinese revenue, what I would call diluted AI exposure compared to the competition, and frankly, some very concerning insider selling signals. To me, what you're calling a discount looks a lot more like a geopolitical ceiling.
I see why you might think that looking at the surface, but let me give you a different perspective on the valuation math. We're currently seeing AMAT trade at a PE ratio of roughly, 29 to 34 times earnings? Now for the listeners, compare that to Lam Research, which is trading at nearly 46 times, or ASML at roughly 44 times. That is a massive gap. My position is that the market is obsessing over AI purity, chasing the hype, and completely ignoring the stability of AMAT's dominance in materials engineering. This is the adult in the room. We have institutional ownership somewhere between 83 and 92%. This isn't a speculative bet. It's an institutionally gated equity. And the company is pivoting successfully toward ICAPS. That's IoT, communications, automotive, power and sensors. And we are staring right down the barrel of the gate-all-around transistor inflection. That is a massive technical shift where AMAT's deposition expertise is absolutely critical.
That's a compelling argument on paper, but have you considered that diversification in a specialized boom like this actually acts as a drag, not a benefit? I'm looking at AMTT as dead money relative to the AI supercycle. Look, the market pays for narrative, and right now, the only narrative that truly matters is high bandwidth memory, or HBM. AMT just missed that premium. And we cannot ignore the financials regarding China. The report projects a revenue hit of $600 million to $710 million for fiscal 2026 due to U.S. export controls. You call it a pivot. I call it a hole in the balance sheet. When you have a company losing that kind of revenue due to structural bans, the value you see is actually a reflection of reduced growth potential.
I'm just not convinced by that line of reasoning, because the China digestion, market speak for that drop in demand, is a known quantity. The market knows about the $700 million hit. It's priced in. But let's dig into this valuation disconnect a little deeper. You mentioned the AI supercycle. Why do you think the market is punishing AMAT so severely compared to Lam Research?
It's simple mechanics. It's the memory premium. Lam Research has outperformed AMAT significantly. We're talking plus 197% versus plus 80% on some metrics over the last year. So why? Because AI servers run on NVIDIA GPUs, and NVIDIA GPUs require high bandwidth memory. To produce HBM, you have to stack DRAM dies, these memory chips, vertically. And that process is extremely intensive in what's called high aspect ratio etching.
Right. Drilling very deep, very narrow holes to connect all the layers.
Exactly. And Lam Research dominates that specific etching market. They are selling the pickaxes for the gold rush. AMAT is involved, sure, but their exposure is viewed as diluted because they are so big in everything else. The market sees Lam as the Ferrari built for this specific racetrack, while AMAT is, well, it's a heavy-duty truck. It carries a lot, but it just can't sprint.
That's an interesting analogy, though. I would frame it differently. You were focusing on the current HBM hype cycle, which is valid, I get it, but you are ignoring the next massive shift, the 2-nanometer logic node. The industry is moving to gate-all-around, or GAA, transistors in 2026 and 2027.
And just for the benefit of the audience, let's clarify that. We're moving from FinFET, where the gate covers 3 sides of the channel, to gate-all-around, where the gate literally surrounds the channel on all 4 sides.
For Sunnysley, it allows for much better power control and higher performance. But here is the key investment implication. Making a GAA transistor isn't really about etching holes, it's about deposition. It requires complex epitaxy growing crystal layers and selective removal processes. You are literally building structures atom by atom. This plays directly into AMAT's materials engineering strength. So while everyone is chasing the memory trade with Lam, the logic foundries TSMC, Intel are ramping up for 2-nanometer. Keyband analysts have argued that AMAT's exposure to GAA is undervalued. This could be the catalyst that closes that valuation gap. You're buying the past winner with Lam. AMAT is the play for the logic transition.
I'm sorry, but I just don't buy that the market is looking that far ahead with that much optimism. The market pays for current AI leverage, not some future logic node promise. And even if GAA is a tailwind, does it really offset the China drag? Let's look at the numbers again. China revenue is dropping from over 40% of the mix down to approximately 25 to 29%. That is a massive correction. And the report highlights a mechanism here that's really worrying: panic buying.
Meaning the surge we saw in 2023 and 2024?
Yes. Chinese manufacturers were front-loading equipment purchases, basically buying everything they could get their hands on to beat the looming sanctions. That pulled demand forward. So now we have a vacuum. It's not just that they can't buy certain tools, it's that they already bought what they could, and now they are digesting it. You can't sell a new washing machine to someone who just bought 3 of them last year.
I acknowledge the digestion phase is real. The report is clear on that. But this is where the ICAP's defense comes in. I mean, AMAT isn't just sitting there taking the hit. They have pivoted toward mature nodes, the ICAP segment. These are chips for cars, sensors, power management. These areas are less restricted by export controls. It provides a revenue floor, and regarding the financial outlook, look at the projections. Fiscal 2026 is the trough. Analysts expect flat earnings growth, about a 1.6% increase to $9.57 EPS. But look at FY 2027. The projection is a 20% jump to $11.43 EPS. The market is forward-looking. If we are buying for 2027, we are buying a 20% growth story at a 30x multiple. That is rational pricing.
But is the ICAP's floor as solid as you think? The source data suggests that even the ICAP's segment is showing signs of slowing due to weakness in industrial and automotive end markets. You can't pivot to a safe harbor if the harbor itself is drying up. And regarding that flat growth in 2026, in a year where AI spending is exploding, flat growth is effectively a contraction in market share. While peers are growing double digits on HBM demand, AMT is treading water just to absorb the China loss. That opportunity cost is why the stock is dead money to me.
I think dead money is a little hyperbolic given the capital returns and the stability, but let's shift gears to who actually owns the stock. There is a lot of noise in the retail space. People comparing AMAT to NVIDIA and complaining it's boring.
It's more than just complaining. There is a persistent narrative on StockTwits and Reddit about a short squeeze. I want to dismantle that right now. It is completely disconnected from the data. We are looking at short interest of roughly 14 to 17.7 million shares. Now, to a retail trader, 17 million sounds like a lot. But relative to that massive 790 million flow, it is a meager 1.77 to 2.82%.
Exactly. It's a drop in the ocean.
A squeeze typically requires short interest exceeding 10 or even 15%, situations where there are more buyers than sellers available. We are an order of magnitude below that. And here's the kicker. About 45% of that short volume occurs in dark pools.
We should probably define that for the listeners. Dark pools are private exchanges for institutional investors, basically trading venues that don't display the order book to the public until after the trade is executed.
Right. They use them to avoid moving the market price with massive orders. When you see short volume there, this isn't some hedge fund betting the farm that AMAT is going bankrupt. This is structural hedging. It's institutional desks managing risk. Maybe they're long a basket of semiconductor stocks and shorting AMAT specifically to hedge out the equipment cycle risk. It is risk management, not a speculative attack.
I agree completely. This totally debunks the retail squeeze fantasy. But to me, that low short interest is actually a bullish signal. It means there is no convicted directional bet against the company's solvency. And you mentioned the institutional dominance, roughly 3,579 institutional owners. The vast majority, over 3,500 of them, are long-only investors. Sure, we saw a minor outflow of about 1.02% in ownership recently, likely some sector rotation. But this is a massive stability buffer. Retail investors suffering from NVIDIA envy, wishing every stock moved like NVIDIA, need to understand that they are just passengers. BlackRock and Vanguard are steering this ship. That institutional floor is why I call it a safe haven.
Stability is great, but let's talk about the captain of the ship. We need to discuss the governance and specifically the trading signals coming from CEO Gary Dickerson. This is a major red flag for me.
I suspect I know where you are going with this, the insider sales.
It's in the filings, plain as day. We see a consistent pattern of stock dispositions. In December 2025 alone, Dickerson sold blocks of shares. One transaction was roughly 130,000 shares at $256. Before that, in June 2024, he sold over 376,000 shares. When the CEO is selling consistent blocks near all-time highs, that is a signal. It suggests management views the stock as fully valued. If the 2027 growth story, that 20% jump you mentioned earlier, is so explosive, why is he cashing out now?
That is a harsh interpretation of standard executive compensation planning. Look at the other side of the ledger. Dickerson still retains approximately 1.7 to 1.8 million shares. That stake is valued at over $400 million. That is significant skin in the game. His interests are absolutely aligned with shareholders. Most of these sales are likely 10b5 plans.
Which are pre-scheduled trading plans.
Correct. They are set up months or even years in advance to avoid any insider trading accusations. You can't penalize a CEO for monetizing some of their equity after presiding over 6 years of consecutive revenue growth. He's taking some chips off the table, not abandoning the casino.
But it's not just the selling, it's the context. He's selling while the company is executing a workforce reduction. They announced a cut of approximately 4% of the workforce, roughly 1,444 positions. You might call it realignment, but combined with the insider selling and the China revenue loss, it just looks defensive. Dickerson cited automation and geographic shifts, but to me, this signals they're preparing for a leaner, tougher operational environment in 2026. You don't cut 4% of your staff if you are about to hit a massive growth spur immediately.
I view the workforce reduction differently. Dickerson was clear that this is about freeing up capital for R&D and AI and advanced packaging. The company is pivoting. You cannot carry legacy cost staff focused on older technologies when you need to compete in the 2-nanometer and advanced packaging era. It's a strategic realignment, not a distress signal. And frankly, in this industry, if you aren't optimizing your workforce for the next node, you are falling behind. It's brutal, but it's necessary for that 2027 growth we talked about.
We can debate the intent, But the optics, selling shares while laying off staff and facing a $700 million revenue hole, do not scream buy with both hands to me. It feels like they are battening down the hatches.
I see why you'd think that, but let's step back and look at the intrinsic value. We have quantitative models, some DCF, discounted cash flow analyses, using conservative 7% growth inputs, suggesting a fair value in the $194 to $216 range.
Exactly. Trading in the $250 range, it is already at a premium to those models. The price implies an AI option. It implies an expectation of growth significantly exceeding that baseline. If the AI demand falters, or if AMT doesn't capture enough of it because they are stuck in the truck lane while Lam is in the Ferrari lane, there is significant downside risk back to that fair value.
But sell-side analysts are looking at a consensus target of around $282, with bullish outliers like Jefferies seeing a path to $360. They're betting on the supercycle. And this brings me back to my core thesis. You have a company trading at 30 times earnings, in a sector where its peers are at 45 times. You have a clear catalyst in the 2027 GAA transition where deposition is king. You have a stable institutional floor. The China digestion is a temporary hurdle, a one-year event. To me, AMAT is a sleeping giant trading at a rational price. It's the definition of a value play in an overheated market.
And I remain skeptical. To me, the stock is a value trap. The geopolitical revenue loss is real, it's sustained, and it structurally lowers the ceiling on their growth. The company lacks the pure leverage to the AI HBM narrative that drives peers like Lam Research. You are buying a diversified materials company in a market that wants a specialized AI weapon. And when I see the CEO selling into this price level, it confirms to me that the upside is capped. The discount exists for a reason, and usually the market is right about these things.
So it seems we have reached the fundamental divergence. I see a margin of safety in a future logic boom. You see a geopolitical ceiling and a missed opportunity.
Precisely. And for the investors listening, the next few quarters are absolutely critical.
We can agree on that. The key watch item for Q1 and Q2 of 2026 is the China revenue floor. We need to see if it holds at that 25% level or if it slips further. If it breaks below 25%, your bearish case gets a lot stronger.
And equally important, we need to see if AMAT announces any specific wins in HBM packaging or etching. They need to challenge this narrative that Lam Research has already won that market. Without that, the AI envy from retail investors and that valuation gap will persist.
So investors ultimately have to choose between the, let's call it safety of AMAT's broad exposure or the momentum of the specialized peers. There is certainly more to explore in this material as 2026 unfolds.
Indeed, the data will tell the story.
That wraps up our analysis for today.
Until next time.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching and see you next video. Bye-bye.